One of the questions that we get the most often is, what is the difference between a bond and a bond fund? A bond is a debt instrument that's issued by a borrower to a lender, which would be you when you buy the bond, which is a promise to return the principal value borrowed at some point in the future, plus the interest payments made along the way, much like you have with a mortgage when you borrow money from the bank to buy your house. A bond mutual fund invests in a pool of these bonds for the purpose of creating return over time. The biggest difference between a bond and a bond fund is that when the bond matures, the principal is returned to you as an investor along with your interest payments. A bond fund never actually matures because you are invested in a pool of bonds that are continually being reinvested. So from a capital preservation standpoint, the best choice is to actually own the individual bonds in your portfolio. A bond fund is the best choice for playing the direction of interest rates. Much like investors buy stocks because they think the stock market is going to go higher, investors buy bond funds with the expectation that interest rates are going to go lower. Now, why would that be the case? The first thing we need to understand is how interest rates affect bonds. This example shows a bond that has a 5% coupon. Let's assume for a moment that interest rates are also at 5%. At maturity, the bond will return to you your original $1,000 investment plus your $50 in interest, giving you a total return of $1,050. The yield to maturity is the same as the coupon at that point, being 5%. But let's assume interest rates go up. If interest rates go up to 7%, as shown here, the price of the bond has to go down in order to allow for the ultimate return to be the same as the current interest rate environment. So in this case, the price of the bond would fall to $980. You receive your $50 in interest. But since the bond returns $1,000 at maturity, your total return is $70 or a 7% yield, the same as the current interest rate environment. The important point about this is to understand that there's an inverse relationship between the rise or fall of interest rates and the rise or fall of bonds. But then again, since you own the individual bond, it's not as big of a concern if interest rates go up because, well, the bond will mature at face value. You will get the return of your principal at maturity. It's much more of a concern when interest rates rise and you own a bond fund. Since the bond fund doesn't mature, the risk is a long-term loss of capital. As this graph shows, as interest rates rise over time, the prices of bonds will fall. But as I was saying, in this next graph, when I own a bond fund and interest rates rise, there is a depreciation in the value of the fund as interest rates go up. However, as you'll notice, when I own the individual bond, while bond prices will also fall as interest rates rise, at maturity, the entire principal is returned to me as an investor. Bonds or bond funds. So which one is right for you? Well, this is where it comes down to deciding really what it is inside of your portfolio that you're trying to achieve. If you need principal preservation, a defined maturity date, a definite income stream, and liquidity is not an immediate concern for you, then buy individual bonds. But if you need an investment that is a bet on the direction of interest rates, an indefinite maturity, immediate liquidity, principal preservation is not a requirement or a key concern at this point, and defined income is not as important, then a bond fund might be right for your portfolio. But when it comes down to deciding what's best for you as an investor, it's always important to consider why you're buying any investment. How does it fit into your overall portfolio? Does it increase or reduce volatility risk? What is the ultimate goal? Is it capital appreciation or income? These are the questions that you need to answer for yourself before making the decision between buying individual bonds or bond funds. As always, you can get this and more information at our website, realinvestmentadvice.com.